Now, the other difference between now the accounting profit and taxable profit, we have referred to that as the timing difference, as the timing what? Difference. Now, when talk about this difference here, it is a difference between accounting profit and taxable profit, which arises as a result of taking into account various items of income and expenses in the computation of accounting profit and taxable profit, but in different accounting period. In different accounting what? Period. For example, we may be having an item of expense which is taken into account in the computation of accounting profit, maybe in the year 2019, but that item of expense will only be allowed for tax purpose, maybe in future, like in the year 2022. What that means is that that difference between the accounting profit and taxable profit, which arises in the year 2019, it will then reverse in 2022. So therefore, this difference here is the one thing which give rise now to timing. It give rise to deferred tax. So first of all, we have said that this is the difference. The difference between this is the difference between the two profit, the difference between the two profits, profit, that is definitely the accounting profit and taxable profit, which arises as a result of taking into account various items of income and expenses, income and expenses, take into account various items of income and expenses in the computation of two profits in different accounting period, and therefore what we have said is that this particular difference here, that is the timing difference, it is the one which will give rise now to what we refer to as a deferred tax. And I want to illustrate using a very, very simple illustration here how a deferred tax will arise, so that as we move forward, you'll be in a position to understand how a deferred tax do arise. Like maybe let's assume in the year 2018, a company reported accounting profit. Remember, we have said that to talk about accounting profit, this is what in other terms referred to as a profit before what? A tax. Maybe the accounting profit was 15 million, and then you are told in the same year, that is the year 2018, the depreciation on a certain asset which now was charged in the income statement was maybe 5 million, and then we also told that during that year the capital allowance maybe was like 8 million, and then still we are told the tax rate during that year maybe was 30%, and then what we are then required to do is to compute now the deferred tax. We compute deferred tax. Now what you have said is that for us now to be able to compute now the actual amount of tax which is supposed to be paid, that actual amount of tax should always be computed on the taxable profit. But in this particular case, first of all, for us to be able to compute this deferred tax, we say that during this year 2018, this company was supposed to pay all the amount of tax which was supposed to be paid. The amount of tax which was supposed to be paid supposed to be paid, this tax will be based on the profit, will be based on what? On the profit, because generally what you have said is that the tax which is supposed to be paid should be based on the profit. Basically, when talk about profit, or generally when talk about profit, you're talking of the accounting what? Profit, means that the amount of tax then which was supposed to be paid during this year will be given by the profit which was reported by that company, and then we multiply that with the tax rate, which is 30%, and that will give us 4.5 million. So during the year 2018, using the profit which was reported, that is the accounting profit, then this company was supposed to pay a tax of 4.5, but that is not the tax which will be paid, because the actual or the current tax which is supposed to be paid, we have said it is computed based on taxable what? Profit. So therefore, what we need to do from this information, let's compute the taxable what? Profit. We compute the taxable profit. Now the taxable profit in this case, what we know is given by what we refer as accounting profit. This we need to remember from what you did in taxation. Accounting profit in our case is given as 15 million. For us to compute the taxable profit, to this we need to add back any desirable expense which was deducted in arriving at that what? Profit. Now, meaning that we need to add all desirable expenses, expenses. Now, from this information which we have here, where we have depreciation and capital allowance, we know that depreciation here, this is a desirable expense. Is a desirable what? Expense. Means that for taxation purpose, depreciation is treated as non-deductible or desirable expense. So therefore, what we need to do here is we come back and or we add back depreciation. We add back depreciation, which in our case is an amount of how much? 5 million. We add back that. And then once we add back, we are going to get 20 million. And then to that, we are supposed to less the allowable expenses, which have not been deducted in arriving at that what? Profit. Now, in our case, what we know is that when computing the accounting profit, a capital allowance is never included there as an expense, because this is considered in taxation, or basically when computing the taxable what? Profit. So this capital allowance we know is allowable expense, but it has not been deducted in terms of arriving at that what? A profit. So therefore, our allowable expense here is a capital allowance, and which is an amount of 8 million, So once now we deduct that, in our case we are going to have 12 million. So this is now what we refer as the taxable profit. Basically, in our case, therefore, you can see that our accounting profit, which is 15 million, is different from the taxable what? Profit. And therefore, using this taxable profit, we can be able to compute the current tax. Remember, from our definition, we have said that the current tax is the actual amount of tax which is supposed to be paid. So therefore, the actual amount of tax which was supposed to be paid, actual tax, will be equal to 12 million times the tax rate, which is 30%, and this will give us 3.6 million. So therefore, what we need to do here, if you compare these two taxes here, if we compare those two taxes, we have said that in the year 2018, based on the profit which was reported by the company was supposed to pay a tax of 4.5, but that is not the actual amount of tax which will be paid, because the actual amount of tax which is supposed to be paid should always be based on this what? Profit. Means that the actual amount of tax which the company will pay to tax authority or maybe to the government is an amount of 3.6, and therefore you can see that the company then has paid less tax than it was supposed to pay, and therefore the difference between those two figures there is now what we refer to as deferred tax, tax. So therefore, the deferred tax in our case will be equal to what was supposed to be paid as tax minus 3.6 million, and that will give us now a difference of 0.9. Now this 0.9 here is what we refer to as a deferred tax. Remember what we have said is that in very simple terms, deferred tax is the tax which was supposed to be paid during the current year but has been deferred. It will be paid on a later period, or is a tax which the company was supposed to recover during the current period but has been deferred and it will be recovered on a later period. Because like in our case here, you can see the company was supposed to pay 4.5, but how much tax will be paid? 3.6, meaning that then the company has paid less tax than it was supposed to pay, meaning that this 0.9, then it is a tax which was supposed to be paid during the current year, but it will be paid in what? In future. Now, according to IS 12, a company is required to provide for this, this, meaning that whenever the company is preparing the income statement, it should take now this particular accounting profit here, that is 15 million. The company is supposed to deduct what? 3.6 million. 3.6, now remember here in our case, is the current what? Tax, is the current tax, the actual amount of tax which is supposed to be paid. But other than deducting that particular amount of 3.6, the company is also supposed to deduct an amount of 0.9. Now this 0.9 is known as deferred tax, is known as deferred what? Tax. Basically, deferred tax is not a tax which will be paid during the current year, but we have said this is just like a provision, because during the current year the company was supposed to pay 4.5, but it has paid 3.6. So therefore the company should provide for less tax it was supposed to pay during the current year, because by the end of the day it will have to be paid in what? It will have to be paid in future. So therefore, in very simple terms, that's how a deferred tax is, or basically deferred tax arises. So therefore we do have those as basically the various formulas which use in terms of computing now the free cash flow to equity.